Okay, now you're good.
Good day, everyone. This is New Harbor Financial for our third live question and answer of 2026. Today's March 12th, Thursday, March 12th. We've got our whole investment management team here, and Regina, thanks for getting us all here. And we could all say hello. I'm Justin Griffin.
Hello, Mike Preston here. Welcome, everybody.
John's muted. And maybe Jay, do you want to introduce yourself?
Yeah, I'm Jay. I'm the trader here, guys. How's it going?
And hello, everybody. Sorry I was on mute. John Lodra, good to see everybody. Thank you for joining us.
Hi, I'm Michelle Moss. I do a lot of financial planning here.
Great. And Regina, yes, you're here.
Hi, everyone.
No.
I'm here.
Today, we're going to start off with Michelle kind of sharing some high-level dates and some timely tax tips here as it relates to filing taxes and such and deadlines.
Sure. So I want to give a shout out to Regina Milcani, who sent out a great email to clients just detailing a lot of the forms that they can expect to receive. So many people who have taxable accounts, they'll receive 1099s. Sometimes there's been an update to them, so for different transactions. So most of them are out. If you've taken a distribution from a retirement account, you'll receive a 1099 for that. And then there are some things that still can be done for the tax filing. So you can contribute to traditional and Roth IRAs up until April 15th for the tax year 2025. You have a little bit longer for SEP IRAs and solo 401ks. You can always check with your CPA, but you can you could do it until you file on extension. And then HSAs as well for April 15th. So those are a couple of the highlights, but if you have questions, reach out to us.
Thank you, Michelle. John, I'm going to kick off the questions here. We've got a number of good ones here. And first one to you, John. For someone considering retirement in the near future, what is a reasonable amount of to withdraw without depleting the principal before and after taxes?
Thank you. That's a great question. And the reason we love those kinds of questions is because it reminds us and hopefully reminds our clients, what their money is really for. For most of our clients, they've done a great job saving and sacrificing. And it thrills us to be able to see them use their money to live off of in a thoughtful and sustainable way. So great question. So there's a bit of conventional logic and back of the envelope, kind of rules of thumb that we think are quite appropriate, but with some very important caveats. So you might hear people refer to, what's called the safe withdrawal rate. And usually you hear a percentage, something like 4 to 5% of your nest egg that you can, quote unquote, safely withdraw in a given year and have a very low probability of running out of money, even if you live, a very long life, life expectancy plus kind of thing. Of course, that for many people, if someone, for example, is 65, that may very well be a 25, 30, 35, 40-year type period. Certainly if longevity is in the period. So in some ways, you might be retired for as long or longer than working lives, right? So it's a long period of time. And so built into that rule of thumb is, kind of the likelihood that you're going to need to give yourself a raise for inflation over time, right? We all know that inflation is a kind of a silent killer, if you will, of a financial plan, and things cost more today than they did 10 years ago and more than 30 years ago and so on and so forth. So it's a great question. Now, we think it's a useful rule of thumb and quite appropriate, with the very important caveat that the biggest risk to that rule of thumb is suffering large declines in one's investment portfolio. And in fact, I can make a blanket statement, and there's a mathematical proof to this. You can show a withdrawal scenario and show that it's probably a better outcome in terms of the sustainability of your funds to have a lower volatility portfolio, even if it's lower returning in terms of average annual returns, than a higher returning but a much more volatile, because these drawdowns are really what can kill that safe withdrawal rate. Okay, and that's why we are so persistent in always wanting to be thinking about what the risk environment is in the markets. We happen to be at a present time where, categorically, this is black and white data. It's not subject to debate or opinion. We are in the U.S. market, anyways, at the highest valuations of all time. Now, if history is any guide, that likely means that we're looking at a decade of passive returns in the stock market that are not the 10% annual return that people seem to always think the stock market is destined to deliver. And probably more like flat, maybe slightly positive, but actually maybe even negative over the next decade. That's what the history tells us. Now, what also history has told us is that even if that were to happen, it's not likely to be literally a flat market. It's likely to be defined by very big drawdowns that can be absolutely devastating. That, like, for example, in the tech bubble of 2000, the S&P actually delivered negative returns in the following decade. Nobody would have believed that outcome if you were talking to them in the hype of the tech bubble of 2000. Yet that's exactly what happened, because valuations were off the charts. And here we are, even more extreme valuations than then. I'd like to share a little kind of simple analysis that I put together to kind of speak to the importance of this and what we call sequence of return risk. So I'm just going to share my screen here, and hopefully that will come up pretty quickly here. All right, so hopefully folks can see that. I apologize if it's too small, but basically we have a scenario just up the top here. You got this, the title here is retiring at an unlucky time. You can't choose your age. You can't choose what conditions are when you retire, but you certainly can position investments accordingly. And what I've done here is I looked at an actual 25-year period starting in the year 1973. These annual returns in the S&P 500 are the actual returns that the S&P 500 experienced. Over that long 25-year period, it averaged 10.1%. Great average return, right? But what happened is there were two big down years in the early 70s. This was in the stagflationary period of the 70s, oil spikes and things like that. We all know that history. And what I've shown here is if you started with $1 million nest egg, and assume you take 5% out each year, so that's $50,000 in the first year, and then increase that by 2.5% inflation every year, you see the withdrawal rate goes up. But notice what happens here. Under this scenario, because the big losses in the early year, the ending value of the portfolio actually runs out of money. You go negative before the 25 years. That's a horrible outcome, right, for a retiree that doesn't get a do-over. Now, if you take the same returns and just reverse the order, that's what this side shows. You can see the 31% in the last year becomes the 31% in the first year, and so on and so forth. So the losses are in the later years, the tail end. Vastly different outcome. You can see the average returns are still 10.1%. But look at this simple example. You not only don't run out of money, but that portfolio continues to grow. This is our big beef, if you will, with kind of the traditional logic of buy and hold passively. It works great in a long-term sense, but it really, when you're in withdrawal mode and needing to spend your money, that sequence of returns can be devastating if you're not careful. So our investment approach, and obviously we're happy to talk with any client about this, we're really focused on, first and foremost, when risks are high, playing defense. Whether you're younger or older, we think playing defense and being, like, for example, we're underweight equities right now compared to what most investment advisors would have clients. And for those clients that are able to use options in their accounts, we have hedges in place right now. So hope that answers the question. It's a fabulous question, and it's one that we think about, keeps us up at night quite a bit because it's so important to our clients.
Thank you, John. Michelle, next question to you regarding Roth conversions. This is actually a client that's asking this question, and I just looked them up, and we should definitely chat soon. Being 65 years old, is now the best time to begin Roth conversions, converting some of my IRA to Roth? Do I need to do it before I file my taxes for April 15th? Maybe share some thoughts on that, Michelle.
Sure. Great question. We were talking at the beginning about contributions to retirement accounts, and you can make contributions to IRAs and Roth IRAs after April 15th. But when you're taking money out of an IRA or a Roth IRA, it always counts in the year you've done it. So you won't be able to do a Roth conversion and have it count towards 2025. If you do a Roth conversion today, it would count for tax year 2026. For the strategy of evaluating whether it's a good idea for you, there's a lot of unique factors to consider besides just your age. The fact that you're 65, and if I think this client might live abroad, but if you are in the U.S. on Medicare, just note that if you're 65, you want to make sure your Medicare premiums are not affected. So IRMA is something that we monitor when we're helping clients evaluate Roth conversions. And actually, there's a 2-year delay for Medicare premiums to adjust for the income. So basically, if you're 65 in tax year 2026, if you did a Roth conversion, it would affect your Medicare premiums potentially 2 years later. So that's just kind of a rule that we like to keep track of. And then when it comes to evaluating whether Roth conversions are appropriate for you, we want to look at your tax bracket, not just this year, but over time, to see if you are expecting higher income in the future. And then it could make sense if you're in a low income year to do it. But also your legacy goals and other things around your life stages we would want to take into account as well.
Thank you, Michelle. I'll just add, the age 65 tends to be, the average retirement age for many, and that's also a decision. Do you start Social Security a little early at that point? Do you wait to full retirement age? Do you wait to age 70? So there's typically a couple of years there where one's tax bracket could be much lower if they've just retired, and maybe delaying Social Security and doing some Roth conversions could make sense. So please, let's connect and chat about that in your specific situation. Mike, I'll let you start this one, and John, I think there's a couple questions here that you both can kind of jump in on. What are you doing to protect investments in non-U.S. assets during this war and its effects?
Hello, everybody. I would say that what we're doing to protect international assets is literally the same thing as we're doing to protect any assets. We have a fairly significant international exposure. It's about 15% or so out of our 47% equity exposure. So it's about a third of our equities. We like international stocks because, well, A, their relative strength is better, and B, their valuations are better. And so basically we're just following our charts. We do have some general hedges that we just added to our portfolio last week with the breakdown on our indicators. We did add some hedges down at S&P 6,500, some April puts, so that would take some of our equity exposure off in general. It would drop us from about 47% to about 32% if we went through 6,500. But that's not really saying anything about international in particular. Let me share some charts and we can just kind of talk through some things here. Let me share the screen. And I'm not so sure that I can, you guys just tell me if this comes up okay. You see it, Justin?
Yes, popped up, pipes is up.
All right, so I started with ILF. Latin America is a pocket within emerging markets that we like a lot. And as you can see, it has sold off here, but not that bad. EEM and EFA are our other two. EEM, emerging markets. In general, we like emerging markets. And it's been on a tear. Year to date, before this pullback, year to date, we were up about 20% in emerging markets, and the S&P was hardly up. And now it's been a pretty smart pullback, but not so bad that it's something that we're too concerned about. I'm sorry, that's EMM. EEM looks very similar. EEM, iShares Emerging Markets, was up quite a bit, and now it's still up. If you look here at 57 versus starting the year at 54, it's up about 6-7% on the year. The S&P, I believe, is negative on the year now. It is. The S&P is down about 2-3%. So emerging markets are outperforming the S&P year to date. If we look within emerging markets at Latin America, which we also have, that too is up almost 10% year to date after this pullback. We also have the EFA, which is Europe and the Far East. And a lot of people might be saying, well, Europe, it must be getting killed here. And they have been getting hurt more on some days than the S&P. But still, if you take a look at EFA, which is the Morgan Stanley Composite Index of EAFE is Europe and Far East. It's still up a little bit on the year. And it's really not giving us any technical sell signals yet. And in fact, it's just barely through the 50-day moving average. So we're watching closely. If we start to see in our system bigger sell signals, if we start to lose the 200-day moving average here, then we'll start to get a little more concerned. But bear in mind, like I said, on the S&P itself, zoom in a little bit, down here at 6,500 where this red line is, we have some hedges in place. So if we were to get a waterfall decline, it would take some of our exposure off just going through that line, and that would help protect international. One more thing about international that I might say is here's a daily chart of the dollar, DXY. The dollar, let me start with actually weekly. It's been in a big downtrend here really for about a year and a half, and it's been basing out here for the last 6 months. Recently, the dollar index over the last 8 weeks went from 95 to 99. And so with a rising dollar, that's a tad bit of a headwind to international stocks, and yet international stocks have done very well year to date. In fact, beating the S&P year to date. Going into a daily chart, we don't really start to notice or get too concerned about dollar strength until we have a real durable breakout above 100. It's this red line here. So if we go above there, have a couple closes above there, we'll start to wonder if we're going to see some more headwinds for our international stocks, maybe more headwinds for gold and silver. But right now, we have not been able to get above that level, and we're not too worried about it. So I know that's a long answer, but we still favor international and emergent. It's beating S&P, and if it starts to deteriorate more, we'll start to reduce exposure, but we're not seeing that yet.
Mike, next part of this question, as investors, how should our mindset be evolving with the changes in the Middle East? Maybe speak to current events and maybe our thoughts on implications of this in the financial markets and what we're looking to do.
Yeah, how should our mindset be evolving with the changes in the Middle East? I think one thing that we're going to want to be aware of is that there's a lot of charged opinions about what's going on, and the truth is, it's other than speaking out about what we think about it, there's really not much we can do other than to react to what is actually happening. What's actually happening is the market's holding up amazingly well. Now that may change any moment, but if I could just go back to sharing. I'm going to go ahead and do that. Just give me 1 second to bring it up. The S&P, going back to the S&P, is literally, here's the high of 7,000. We're at 6,700. We're about 300 points off the all-time high. We're about 3% off the all-time high and about 2% down year to date. And so we've been watching this triangle here, and so far the S&P broke down. I think the war news came out around here. I think this is probably the first Monday we actually came back and rallied, and the market was surprised. There wasn't much of a reaction, and still there's not much of a reaction. The market tries to go down, it recovers. The bigger reaction has been in oil. USO is an ETF that tracks oil. I mean,
I don't see your screen, Mike. Does anyone else see it?
Okay, sorry. I must not be following.
Okay. There it is. Now it's going. Yep,
okay.
Here it is.
Yeah, USO is a ETF that follows oil. That's been the big mover. So those that bought oil right away, depending upon when you did it, it actually was profitable. Normally, if you do something after a big story breaks, it's not usually going to reward you that much. I don't know if anyone was following silver, but silver, take a look at this. It had opened way up in the 90s in the pre-market, but literally has done nothing since the war news came out. So if you tried to buy silver or gold when the war news came out, you really haven't made any money. If you bought oil, you made money. That's probably the only thing that you could do to make money after the news. And then lastly, the S&P. The S&P is testing the downside, but it remains to be seen whether we bounce or whether we just crack down through. And as I've mentioned before, this put is in place at this line. So if we get a big downside move, it will make us more conservative by default automatically. But the market's a tricky thing. It's surprising that it's only down a couple percent since this news is out. I think that the punchline here is you really can't make investment decisions based on headlines. We make investment decisions based on technical levels, relative strength of what's working versus other things, and price action. That's it. If we start to break down through and stop out of some of our positions, we'll do that. For instance, take a quick look at financials. Financials have been really, really weak. That's not to say they can't bounce, but we're out of financials. We sold that back in the low 50s a couple months ago when relative strength started to weaken. Now it's continuing down, and we won't, I don't think, bottom fish that when we're out of that sector until it proves itself. So we're always looking at different sectors, one versus the other, looking at broad levels in the market and then reacting to that. So again, that's a long answer, but war could mean a lot short, mid, and long term to the world. Now, what does it mean to the market? The market could do a completely different thing. So we're just going to follow the market.
One last thing, Mike, can you pull up that chart again for USO?
I'll
I
get
just
there
don't
in a
want
second.
people, and maybe we could talk briefly about USO and John, maybe you want to jump in here too. I think our understanding is it's not just a pure play in owning a barrel of oil. It's running with futures and contracts, and it could move pretty wildly in both directions. I just don't want people to think that this is a great position to go buy if you want to profit in oil. But if you pull up a 10-year chart, I think we'll see some pretty wild moves back in 2019 or so.
So first of all, USO is a little bit of a flawed product in that the USO is an ETF that buys crude oil futures. And every month or two, as those futures mature, they have to keep buying futures a month or two out. And the curve has been such that each subsequent month has higher prices than the current month. So there's a thing called negative roll yield that's inherent in the oil market and generally the natural gas market. So it's hard to do without losing money. Like, in other words, crude oil could stay flat for a year and you could still lose money buying this ETF because of negative roll yield. So this did go up quite a bit. It's gone from about 80 to about 120. That's a 50% move in a week and a half or so. But I'd be really, really careful buying this here. You'd have to take a look at the shape of the futures curve, which I think is even more extreme in terms of premium to front month or a contangoed market. I'd be really, really careful. The volatility in this thing has absolutely exploded down here, and you probably can't see it, but at the bottom of my screen, I have implied volatility. It went from about 50% to over 100% just in the last couple of days. That means the volatility is extreme. So there's some big players here that are trying to hedge and speculate and stuff like that. I would not buy USO, I don't think, even if I was super bullish on crude. Crude is right around, I think, 100 right now. And it could be 100 a few months from now, or even 110 or 120, and you could still lose money in the ETF. So I would just be very careful about that. It's hard to buy oil in general, which is why historically we have preferred to buy the companies in that space. So we actually have XES in our model, which is oil service companies. For technical reasons, that's probably a better play right now than USO.
Thanks for that context, Mike. That was great. John, I'm going to move over to you. Another handful of questions here, and it's pretty timely as well. Private credit. What concerns do you have regarding private credit and the recent events with redemption gating and markdowns?
Yep, that's a very timely topic. Before I jump to that, I just want to make one more point on the great points Mike just mentioned about USO. So anytime you're investing in a commodity, and none of these things we talk about in this video are meant to be recommendations of any securities for any viewer. That's only a conversation we can have with clients or one-on-one with prospective clients. But when you're investing in the commodity space, depending on the vehicle, it can be very tricky from a tax reporting standpoint. Many of the commodity ETFs, for example, like USO, issue K1 tax forms by way of their structure because they invest directly in futures contracts. And for anybody that's in the midst of doing their taxes that has K1s in the mix, K1s generally are synonymous both for clients and their accountants with headaches. They're usually issued far after 1099s on brokerage accounts are. Oftentimes, many are even issued after tax filing deadlines. So just we try our very best to avoid investments that issue K1s for that and other reasons. So yes, on to private credit. So maybe it's there's a lot of headlines and a lot of very scary headlines in just the last couple of days, frankly, on private credit. Maybe a quick just summary of what private credit is. Okay, and hopefully it's not too basic, but traditionally credit is another maybe jazzy name for lending. Okay, credit is just lending. Okay, so traditionally banks were the entities that lent to corporations and individuals, and over the last couple decades, and especially over the last decade and a half in the wake of the great financial crisis, there's been a ballooning of the amount of lending done by non-bank entities, okay? Primarily private credit funds. These are funds they're not private equity, they're private credit, where they take in investor funds, could be investments by endowments, pension plans, individuals through retail investments, into a fund, and then that fund goes and makes loans out to private companies and other borrowers. And the problem with that, so first of all, in the wake of the great financial crisis, there have been, for good reason, there have been stricter standards placed on banks in terms of how much they can lend out and to whom and this and that. And sure enough, the financial industry does a great job at saying, well, if there's an opportunity, we're gonna go find it. And the private credit funds basically came to the rise here as the banks were less able to lend. And recall that we were in an environment of essentially zero interest rates. So investors, being starved for interest rates, were chasing yield in mass. And just like in the lead up to the housing bust, their private credit investments were quite attractive because they offered higher yields than traditional fixed income type investments. And unfortunately, a lot of these loans were issued without the typical protections that traded bank loans, for example, or traditional bonds involve. Things like lack of or very light financial covenants. These are protections that are in bond investments that for all intents and purposes have been very non-existent or lax in private credit. I'm going to share a study that was done by the Federal Reserve last May, just to give you a sense for how much these things have kind of increased in proliferation. So let me share my screen here. Okay, we'll wait for this to load. So this is a chart. Again, this is a study done by the Federal Reserve back last May. And what it shows goes from 2002 up through, this goes through 2004 at the time. And you can see off the charts, tremendous growth in these kinds of vehicles, right? Great, right? All well and good. And there's, some might be familiar with the abbreviation BDC. That stands for business development companies. These are specific private credit loans that are, structured under a code in the tax code, specifically giving benefits to companies that are organized as BDCs. Beyond the scope of this to get into that, but BDCs and other private debt funds are what we're talking about here. Now, what's happening is these investments, I'll stop sharing for just a moment. These investments, because they're not traded products, the value of these are basically subject to mark-to-market or appraisals, right? And because they don't trade on the market, they don't get a frequent, market test as to what they're worth. So it's almost like the issuers kind of say what they're worth, and you just got to believe them, right? And that's all well and good until it's not. And just in the last, few weeks, we've seen examples of. I think there was it might be a BlackRock or Blackstone. I think it's BlackRock fund that basically a quarter ago had a particular debt, instrument in the private credit fund that was marked to market at full appraised value, 100 cents on the dollar. And then, out of nowhere, they marked it down to, I think, literally 0 cents on the dollar, maybe off there. But point being is, literally, these things can from one day go from being full value because the issuer said they were, to being cents on the dollar because the market finally had a chance to test what they're really worth. And what you have here is a situation where investors in these things, they're starting to be gated. Several funds, a couple in the news just in the last couple of days. Morgan Stanley, big, large private credit fund, started gating redemptions, meaning you can't, limitations on how much money investors can get out. Cliffwater, another big, I think a $33 billion private fund, started gating their redemptions. They, I think, got redemptions requests for up to 14% of the fund. And of course, these kinds of things, these gates are there because of the fact that if these issuers had to sell these in a fire sale, the price would absolutely plummet because they're very liquid investments. So far we're seeing, and we've been concerned about this asset class for a long time. We haven't had any clients in our models invested in private credit funds or BDCs, despite the financial industry knocking on our door with, all kinds of sales brochures and things like that. We've been very reluctant for a lot of the reasons we saw. And the big concern here, I don't want anybody to panic. The big concern here is if it spills over into the broader economy. And one area that we're watching very closely is these same traditional banks that were kind of stifled from lending out to traditional counterparties. They have increasingly been lending to these private credit funds themselves. So let me share a chart from that same Fed study to show you that. Okay, again, this is that same Fed study. You can see these are bank lending to private credit vehicles. You can see off the charts growth there. So we're starting to have some concerns about whether there could be a broader banking issue here. And to speak to that, again, I think it's, we're not the ones to say don't worry about it. It's not a reason to panic, but it's certainly in our minds something to watch closely. And that Mike pointed out is the weakness in financial stocks. It's eerily reminiscent to other big episodes in market history. If you go back to, for example, the housing bust, we saw even before anybody was really talking about subprime and this and that, we saw that the financial stocks really starting to struggle leading up to when the real problems started happening in the housing bust. So let me show you what that looked like. Again, here's the chart that Mike just shared. We can see that year to date, the financial sector is down about, I think, 11% on today's action. S&P is down about 2%. So the financial sector has been a huge laggard so far this year. But if we go back in time, let me just zoom out here. Go back to, I hate to have anybody relive 2007, 2008, but let's do that for ha-has. Here's 2007. Okay. The market, the S&P 500 peaked on October 9th, 2007, I think. Okay. Which was right about here. But you can see financial stocks not only went nowhere, they actually were down on the year at that point. So they were kind of an early tell to bigger issues in the system. That's something that we're very cognizant about, and we're on a high alert for to watch for further stresses in the system. And that should show through our dashboard of market indicators. It doesn't make sense to play more defense. So great question. Something definitely we're watching. And, I wouldn't assume that this is the end of this that we'll be reading and hearing about.
Thanks, John. Jay, I might ask your thoughts on this too. This private credit, my understanding is that 401ks recently were opened up to be able to allow this type of investment, which was, never allowed for the small guy before. Maybe share some thoughts on that.
Yeah, and that kind of ties in with what John was mentioning before with that ballooning of the assets. Something that's happens when you take an investment public is the guys that got in beforehand that were all in when it was private. They wanted to get an opportunity to take their money out, right? So that's when you get it taken public. People sell it to retail investors, and these investments have never been really accessible by the retail investor until past couple of years when the private investors wanted to get their money back, right? And they started to feel like they hadn't been able to in a while. And so, you see that in this, and then also there's a lot of CLO products that take these loans, package them up, put them in stacks of debt, and sell those at a high yield as well. And people grab them because they're reportedly low risk and spin off a high yield. But what we're seeing now is we're seeing a lot of people rush to the exits, and time will tell how that goes as these companies are forced to update their marks.
Thanks, Jay. Mike, this next one to you, kind of based on the U.S. dollar. What is the yield outlook for the short-term U.S. Treasuries and money markets in the next 6 months?
Yeah, it's pretty simple. The curve is very flat. I'll share the screen again and show you some tools that people can use if they want on their own, and or just accept the answer here as putting it out there. But the question is about interest rates over the next 6 months. So there's a couple of tools that are pretty useful. I don't think you're looking at the Treasury yield curve though, right? Let's see. I'm gonna have to share the correct screen. Give me 1 second. Share screen. Okay, hopefully you can see this now, Justin, as it's coming up. You see that?
Very good.
Okay. Yep. All right, so the U.S. Treasury yield curve, take a look here. It goes from between basically 0 days all the way out to 30 years. We have a normal uninverted yield curve for the most part now, where the short maturities have a lower yield than the long maturities. Go out here at 20 and 30 years, you'll see that we're at 4.8 and above on the 20 plus years. But for the front months, basically it's 3.7 or so. You can see this thing come up as I move my cursor. I'll move my cursor out of the way. It's easier to see. Right around 3.7, no matter whether you pick 2, 3, 4, 5, 6 months. Essentially, this is saying the market doesn't see rates changing in the next 6 months. And so, frankly, it doesn't much matter what you pick for Treasury bills. I think I would match it to what your personal needs are. If you know you're not going to need it next month, you might want to grab the 6-month ones because at least you're going to lock in that rate for 6 months if you're buying the Treasury bills directly. If you're in a money market fund, the money market funds tend to continue to roll Treasury bills every single month. So you're probably going to get 3.6 or 3.7 on the money market fund, depending upon which one you're in. But it could go down very quickly if we see rates go down unexpectedly on the front end. But another tool you can use is the CME FedWatch tool. And the market does not expect much in the way of surprises because the current Fed target rate is 3.5 to 3.75. And at the next meeting, which is, let's see, actually, I'm in the wrong one here. The next meeting, which is March 18th, just in 6 days, it's a 99.1% probability that nothing's changing. 3.5 to 3.75. Well, that's no surprise because over here, the market is not expecting any change. But if you take a look at this tool, you can actually take a look at different probabilities. So if I click on probabilities, you take a look at this, and actually I think aggregated works a little bit better. Take a look at the 3/18/26. The market expects no change, 99% chance that it's going to stay the same. That's pretty much true out through April, June, July. Then you start to see a higher chance. Take a look at the light blue. That's going to tell you what the highest probability is, that we're going to drop down 0.25, 325 to 350. All the way out to 2027. We might go down 0.5 point by 2027. So, as you can see here, it's pretty much flat, and then it goes down maybe 0.25 point out here, a year or two. So the long answer there is it doesn't much matter. If you're in money market or anytime within a year, just buy whatever Treasury bills suit your needs. Or if you're in a money market fund, realize that the market doesn't see much chance of rates changing much in the next year. And because there's not really much you can do. Eventually rates are going to go down. Our viewpoint is that's likely to be after some kind of big stock market accident. The Fed will probably panic and change that. But right now, there's very little surprise to be had. I'll stop there.
Thanks, Mike. I might.
Hey, Justin,
go ahead,
Justin,
John.
I just want to add, money markets are safe generally, but we generally recommend a Treasury-only money market account that literally just holds Treasury bills. And I did a video some time ago that went into some changes in the money market rules that were kind of under the radar. Maybe Regina can put up the link to that video in the chat, but folks might want to watch that if they're in money market funds. And for a slight give up in yield, you can get pure Treasury only money markets that we would recommend in this environment, not things that hold repos and things like that. We don't expect there to be stress in money market accounts, but back in the lead up to the housing bust, there was actually some money market funds that went bust because they were invested in things that should have been safe but weren't. So just a quick call out there.
And often in your 401ks, it would be deemed government money market. Sometimes you see treasuries too. Government. Sorry, I got a cough. Mike, question on foreign equities. What are New Harbor's thoughts on ever kind of adding maybe individual equities at some point in time, stocks in international markets?
Thanks, Justin. I think we covered foreign equities a little earlier. I'm not sure if everyone caught that, but in general, we prefer foreign equities for two reasons. Well, maybe I shouldn't say prefer. We prefer often foreign equities for two reasons. Number one, in general, the valuations are lower. And number two, the relative strength has been higher. Take a look at year-to-date returns for international and emerging, and within emerging Latin America right now, they're just better. So we like them, but we don't really see a lot of reason to be in individual equities on an international basis, or frankly, even on a domestic basis. And I think that's what the question is asking, is about individual equities. I think we very well may consider adding individual equities if we get a big crash in the market, because then we could buy big multinational blue chips at valuations that were reasonable. We haven't seen reasonable valuations really in 15 years. But if we could do that and buy good companies, and then hold for years and have long-term capital gains treatment for client and lower fees, because of the fact that individual equities don't have any fees whatsoever, and ETFs do have some fees, although they're very, very low, eventually we might want to hold individual equities. But right now, I don't think so, particularly because we're expecting a big down move eventually in the markets, the U.S. markets, which will drag down international markets. So, right now our exposure is EFA, which is broad Europe and Far East, EEM, which is diversified emerging markets, and then ILF, which is iShares Latin America. The four big countries in ILF, and they're looking really good, is Mexico, Brazil, Colombia, and Chile are the biggest pieces in ILF. So, but again, we don't see any real reason to be in individual names there right now.
Thanks, Mike. I guess to add that too is our use of options are much cleaner on ETF instead of individual stocks, that we may have to have a much larger position in individuals to do that. Michelle, big question here for you on financial planning. How do you go about putting together a lifetime tax plan for a client incorporating Roth conversions, IRMA, RMDs, and future tax law scenarios?
Great question. So this has been kind of a theme we've been discussing, I guess, and doing a lot with clients. And so basically, that's what a comprehensive financial plan is for, to look at your goals and timelines, your income picture, your assets, the distribution of your assets, and where you'll be taking money from throughout retirement. And then when you meet certain milestones like required minimum distributions, take Social Security, and things like that. So in general, and also when it comes to the future tax laws, that's uncertain. The One Big Beautiful Bill was supposed to make those tax brackets permanent. Who knows? But in general, we prefer to look at someone's unique taxable situation. So typically, we're looking for low-income years, and so when people retire, their tax bracket usually drops, and so that usually has a bigger impact on clients, rather than kind of the uncertain tax rates of the future. We don't think that there's going to be necessarily a skyrocket in brackets. So we think that just planning for your situation and making sure you're taking all of the factors into account that apply is usually the way to go.
Thank you, Michelle. Mike, I might do this two-part. It's a precious metals question. We have one live that I'd like to grab. Turmoil in markets because of the war. How come gold and silver are moving lower? What are our thoughts on that?
Well, first of all, I might say, or I might challenge, are they really moving lower, or are they just not moving up? I'm taking a look here, and frankly, we're about the same as we were on silver when the war broke out. As I pointed out earlier, and I could bring up the chart again, I don't really know that it adds much, though. Silver and gold are about the same. So I'm not so sure that they're going down. I think it's just that they're not going up.
And they're both, I think gold is a commodity, silver is a commodity, both up roughly 15 or so % year to date today too. Down a little bit today, of course, yeah. But I think, thanks for that response. The question at a task here for taking profits on precious metals, as we've indicated along the way up for some. What level do you set? A 20% gain, 50%, or so forth? Is there a rule of thumb to follow?
Yeah. So right now, to me, metals are consolidating. I don't see any negative action in metals. I don't think I take, like I just said, the fact that they're not moving up since the war as being a negative. Everything gets sold in times of liquidity crunch, including metals. And so there's this concern that we may have a liquidity crunch, but that remains to be seen. A lot of our clients have a lot of metals. We've been recommending metals for a long time, 5 to 10% of investable assets in bullion, either paper or physical bullion. And the people that took that advice are up quite a bit. And we talk all the time to people that have come to us with a lot of metal or bought a lot on their own, and they have allocations much higher than that. Sometimes as high as 80% or 90% or more. And so really what you have to do is come up with first of all, assess where you're at financially and psychologically. Maybe we can help you with that and figure out just how attuned you are to fluctuations and how much it does or doesn't bother you. If it does bother you, then we're going to want to be more conservative with our plan than if it doesn't. A lot of people are pretty hardened to fluctuations in metals, and thinking about a conversation or two that I've had in the last week, a lot of people have a big allocation, but they're not too sensitive to it. So those people can actually ride it a little bit better. But for most people, I think you want to just assess where you're at. How big of a percentage of your net worth is it, or your investable net worth? And what do you think will happen to gold and silver and miners even? Nobody really knows. But together we can come up with some kind of bias or projection and a plan. So let's say that silver right now is at $85 an ounce. And let's say that we agreed together that we think it could hit new highs again, and maybe even 150 in the next year or two. And we might want to come up with a plan that would have you sell a little bit along the way. maybe sell, if you feel too heavy and you're scared right now, maybe sell some right now. But if you're not, that plan would probably have you selling some higher. Maybe as we near new highs again, sell some at 110, 120, 130, 140, etc. We'd have to come up with some kind of schedule. That's the only way that I know to stay sane, right? And to take some chips off the table, because at some point there's going to be a much bigger pullback and you're going to wish you sold something. So selling on the way up makes sense. If you can connect it to something else in your life that feels real, like a home addition or a vacation home purchase or a kitchen remodel, I found that helps people pull the trigger and take some profit out, because you're converting one real asset into another one. So it's very personal, but we're happy to have that conversation with just about anyone and ultimately come up with some kind of schedule or plan, because that's really the only way to do it.
Thanks, Mike. John, to you, how does New Harbor deal with the current volatility in the markets we're experiencing? And has there been any changes in the market outlook and New Harbor's positioning?
Okay, great. Thank you. Thanks for the question. It's been volatile, right? The headlines and the actual events in the world have been quite volatile. The market has been actually rather intact. I mean, we've seen a little pullback in the market. We're not very far on. Right now, as I speak, the S&P 500 is at 6685. It peaked about a month and a little change ago, just at about 7,000. So I think we're down 2% on the S&P year to date, the cap weighted S&P. So, let's just firstly keep this in perspective. We haven't seen a big degradation in the market. But that being said, our whole system is really meant to be, making discretionary decisions, tactical decisions about when to play offense, when to play defense, and in what degrees. So if we see follow through on any number of our technical indicators based upon a weight of the evidence, there are several tools that we have in our toolkit to manage volatility and I think about it most importantly to mitigate potential for downside risk. The first tool is simply just selling down equity exposure, for example. We've talked earlier how our core tactical model, some clients are by their choice either overweight or underweight equities relative to that, but our core tactical model is 47.5% in equities right now. 20%, if you include a slice of global industrial metals mining companies, 20% is international stocks, and the other 27.5% U.S. stocks. Now we have certain sectors of the stock market in the U.S. that we have chosen because of their trend strength relative to the broad market. But we would have no hesitations when our system, by the way that the evidence tells us to reduce those allocations down. We could easily go down to less than that equity exposure. Is there a time where we might be 30% in equity exposure or 20%? Sure, if the data and the kind of breakdowns suggest that is prudent. We haven't made much in the way of notable changes so far this year. The one thing I will call out, last week we did add for accounts above a certain threshold. Just to remind folks, we use options as a tool, options as a hedging tool, and there's practical size limits as to account sizes in a given account, whether or not we can use those tools. So some smaller accounts, we can't use these tools, just a function of the constraints of options. But so we did add a tail risk, what we call tail risk hedge, that if the S&P were to drop below a critical level, would take about a third of the equity exposure off the table for our clients. So let me show you what that looks like. I'm going to pull up a chart of the S&P 500. And this here is a weekly chart. So this goes back to 2023, I guess. So here we are. You can see this is the year to date so far. In the grand scheme of things, not a huge pullback. Again, year to date, the S&P is down about 2%. Our clients, happy to talk about your own account performance. Most of our clients are up, mid to mid single digits. Obviously it's specific to each person, but we're happy to review your performance and anything there. But you see this dotted line here. This is at the level 6,500 on the S&P. That's a level where if the market were to go below that, this would basically take off about a third of the equity exposure. It's a hedge. It's like an insurance policy. That's what put options are. It's a put option hedge on the S&P 500. And that's only about 2.8% down from here. So it wouldn't take, if folks are worried about a big decline in the market, well, just 2.8% down from here, roughly, we'd take about a third of our equity exposure. So we go from 47.5 to 32.5 thereabouts. So we do have tools. The two basic tools that we use are scaling down the risk by just outright selling down exposure, or using hedges, or some combination of the two. But that's our basic playbook. Always looking at each day anew, and convincing ourselves that the data we're looking at tells us to be how we are, or either more or less defensively postured.
Thanks, John. Jay, if you want to add to this, and there's a couple more questions that kind of dovetail what John was talking about, but what sectors are we pivoting to in the near and long term? That's one part of this question. Thoughts on long-term rates and our current strategy. And the last piece of this really talks about, I guess, if this war does end in the coming, weeks or so, and the dollar resumes its march lower, what are our thoughts on that?
Yeah. And, I think this comes really back to our discipline. We're always looking for opportunities and always assessing what we have against, what's out in the market. And, I was looking at our watch list before this, and, ironically, a lot of those names that we were looking at before have broken down. We were looking at pharma, which isn't hanging in there too well. At one point a few weeks ago, we were looking at, way back, I'm not, I don't want to date myself. We were looking at home builders a little bit. Those are looking really poor. Even, XAR is kind of falling out of bed a little bit. So, I would say that, what we have right now is really what we like in the market where it's at right now, with industrials, utilities, energy. XES looks fantastic here still. So, we're trying to be in the right spots that our system says. We don't try and anticipate too much. We always have our fundamental overlays that we put on top of our watch list. We try and pick things that we think make sense given the current economic regime or given our current outlook. But I would say we're trying to stay ambivalent to that and trying to work backwards from our equity percentage more than, try and get out ahead of any trends. So I would say there's that piece. If the war does end and the dollar resumes its march lower, yes, international should continue to do well in that environment, and we're positioned for that via EMLC and EFA, EEM, so and ILF and PIC, of course. But just all to say, we don't anticipate. We're trying to stay on top of where the market is right now, and try and adjust our equity percentage and our equity allocation on the fly. In terms of longer term rates, I'm going to pass that one off to John and Mike. I think they have some great ideas on that. John?
Yeah, I'll just comment on that. So we are and have remained somewhat underweight longer term bonds, and there's a good reason for that. We haven't seen interest rate dynamics that would, in our mind at this time, justify a heavier allocation to longer term bonds. And I think maybe folks can't see me. I think it's still on Jay, but I'm waving to you in the background here. There we go. I feel sorry you got to look at me instead of Jay, but here I am. Anyways, so we have about a 7.5% allocation in our tactical model to longer term treasuries. And I'll just pull up a chart. So basically, bond investments, especially when you get out longer, the things that drive those the most are readings on economic growth or recession and inflation. Basically, those are the big picture things that generally drive what happens to longer term bonds. Of course, when you get central banks intervening like they did in the wake of the great financial crisis with QE, infinity, where they print money to buy bonds, those traditional economic signals on bonds can distort, and the bond market can have a life of its own. But right now, we've been in this kind of, I'll pull up a chart of TLT, an investment that an ETF that holds longer term treasuries. And this is a weekly chart that I'll share with you. Here we go. This is a weekly chart. Well, let me zoom out to a monthly chart. This is a monthly chart. So first off, bonds got hammered almost predictably, from 2020. 10-year Treasury bond yields got it as low as, I think, 0.4% in 2020. If there was ever an analog to a stock market bubble in the bond market, that would be it. You couldn't almost get any lower on interest rates. So, bonds generally, simple rule, interest rates go up, bond values go down, and vice versa. And the longer the term the bonds are, the more magnified that seesaw dynamic is. But you've had a massive sell-off in bonds over that time. Arguably, you'd say that interest rates now are kind of in normal ranges, historically normal ranges, whereas in much of the decade after the great financial crisis, they were distorted low, by Fed intervention. Well, let's zoom in closer here to a weekly chart. You can see these bonds have been in a range for the last, a couple of years. If you go back, here, TLT has ranged between, let's call it 100 and, kind of the mid 80s, right? So we've been tracing on a range. Now, I'll remind folks that, these longer term bonds are still paying a yield. So even though the price has fluctuated, you're collecting that coupon. So there's nothing wrong with that. Now, I'm going to zoom in on a daily chart here. TLT had started or ended last year and started this year in a downtrend because interest rates were kind of creeping higher. In fact, the what's called the break-even yield, the yield that is kind of the market's expectation of inflation, started creeping up last year and into this year. Now we had a reprieve on that where TLT broke out to the upside here after this down channel here. And, of course, correspondingly, interest rates pull back. I think 30-year mortgages got below 6% for the first time in a long while. But here's what's happened since the war broke out. We've had a big sell-off in bonds and a spike in interest rates, almost certainly related to the spike in oil and worries about inflation. Okay, so that, generally, historically, one would think of U.S. Treasuries as a safe haven during times of uncertainty. But I think the inflationary scare and concerns about the oil spike is probably in the short term here, kind of overruled or overcome that kind of, other kind of factor about bonds. So, we can't say, we think ultimately these yields will go down, probably because we're going to be in a pretty nasty recession or worse. And when yields go down, longer term bonds should be a good place to be. But we're just not there yet. We haven't seen the follow through signal to give us conviction that that time is right now. I don't know if Mike, you have anything to add there.
No, I really don't. It looks like we're just about out of time too.
Yeah, 3 o'clock, everyone. We'd like to cut these off right around then. Thank you so much for joining. Michelle, do you have anything else to add? I think you started with all the tax stuff.
No, I think just happy tax filing. We're here if you need us.
Great. And Regina, thanks for adding our newsletter here, subscription to our newsletter if you want to join, and some other areas too. Thank you, everyone, for joining today. I look forward to chatting with you all soon.
Thank you, everybody.
Have a great day, guys.
Thank you, everybody. Have a great day.